Hello, everyone. Good morning. Thank you for joining us on this Thursday. If you're a Wordle player, welcome to day number 705 of Wordle. Hope you were able to successfully complete the puzzle this morning. Thanks for joining us for our topic today on planning for lifetime income in retirement. We're really happy to provide this to y'all today and hope it gives you good information for your financial planning. You'll see Charlie Curry's with me on the webinar today as well. We're going to be recording this session for those who are not able to attend. And we'll be handling questions and answers through the chat, which you should see down at the bottom of your Zoom screen there. So if you have any questions along the way, feel free to drop those in the chat, and Charlie will make sure we take care of those here near the end of the program. So again, thank you for joining us. We're really glad you're here this morning and looking forward to spending some time together with you. So we'll bring a few informational slides up here on your screen. And you should hopefully be seeing areas of expertise. We just wanted to recap for everyone what we're able to do for you in your financial planning. If there's any services you see there that you'd like to take advantage of or any topics you'd like to discuss with us, please feel free to shoot us an email, give us a phone call, and we'll be happy to integrate this into your financial plan as well. One area that we're seeing from or hearing from clients who are bringing us on board this year is that last year in 2022, they either experienced far worse results than they expected, in a very difficult year. They felt like they were taking on too much risk in their portfolios, or they frankly just didn't hear from their advisor. So we just wanted to remind everyone that you can see the scope of services that we provide for folks in our 90-day milepost financial plan there, that we do have openings in our practice for more clients, a few more. We take these on selectively. So if you're hearing of these issues with some of your friends and family, we're happy to have a complimentary consultation with them to see if there's any way we could possibly help there. So thanks for keeping us in mind for that. We could definitely appreciate that. So on to our topic at hand, planning for lifetime income in retirement. Really just wanted to go through with everyone today, really kind of our basic way of providing income in a retirement plan. There are multiple ways to do that, obviously, and we can touch on those as well, time permitting, but really just wanted to go through one of the primary ways that we try to design an income stream that can outpace both taxes and inflation. So the key idea here is that we're looking at a 3-decade, 2-person retirement for essentially most American retirees. So the problem is not principal protection. The problem is income. We need to be able to generate an income stream that can last as long as you do, or hopefully longer, and again, outpace taxes and keep up with inflation along the way. We don't bring our account statement to the supermarket every week. We bring our income to the supermarket. So this is why we want to talk about the income problem that we need to tackle, not necessarily the growth problem in the portfolio, and then some solutions for helping you with that. So, we've been through a difficult time here in the economy in the last several years, especially since the onset of the pandemic. So just looking at what I call the cycle of investor emotions and kind of how we feel about things, where's the most opportunity for financial risk, also opportunities for financial return, and just the emotions that we go through during economic and market cycles that we deal with. And, it's rightly so, because often our financial livelihood depends on our investments. So when we see them going up, we tend to feel a lot better. When we see them going down, especially when we're taking income, we tend to feel a lot worse. And so we really have to guard ourselves from making emotional decisions in our investments, and hopefully have a good advisor with us that can help us mitigate that. So we all have heard the old saying, buy low and sell high, right? That's when it should apply, but often it doesn't. In other words, we often wait for the right time to invest in order to make our plan. We often wait till we feel good about it. When markets tend to be expensive, we often, when they are down or when they're less expensive, we don't feel it's the right time just yet. So when is the right time for making a plan? You guys probably all know the answer already. It's now, pretty much, before it's too late to make a plan and retirement is staring you in the face. So if it's done right, your investment and your financial plan really should account for where you think you are in the cycle of emotions, and then build your portfolio around that to mitigate some of those risks there. Sources of retirement capital, this is typically what we see in our practice. It can come from a lot of different sources there. But more often than not, what I have seen is that capital comes from just good old fashioned savings and investments, putting money away, owning a business, possibly selling that business or a family farm to generate the capital. We've seen that quite often in our practice, especially as we focus on pharmacy owners to a good extent and in a portion of our business. Sometimes real estate sales can generate capital. We very rarely see, that a significant inheritance or a lucky strike generates a lot of capital for most of our clients. So we don't put a lot of stock in making money in high risk type investments or opportunities like lotteries or crypto or things along those lines. And sometimes it doesn't provide all the capital that's needed. So generally speaking, a thoughtful plan can be crucial to your financial livelihood. And most of what we see from our clients is coming from investments they've built on their own or a business they've sold or something along those lines. So then it needs to be invested prudently to generate some lifetime income. So our essential question really boils down to trying to make sure our income outlives us. That is the real question, is will your income outlive you, or are you going to outlive your income? We really want the former question to be the result for everyone that we're helping, that your income outlives you. So essentially, the challenge is to create an income that is dynamic. It needs to rise through time to offset inflation. It needs to not be static. Static income is going to be good for a while, but it's going to eventually not be enough, and we'll have to get into our principle. So the critical issue is not the level of the income, it's the trajectory of the income. It needs to be able to increase over time to help offset inflation. So how are we going to do that? Well, if you're fixed income, if you focus on that, a fixed income from bonds or CDs or something along those lines, even if it's above your income in year one of retirement, your costs are immediately going to start catching up with you. And we've seen this a lot, especially in 2021 and 22, and here in 2023, with inflation being as high as it has been. So when and where these lines cross is really not the issue. The issue is that if they cross, then you start running out of money, because now you're dipping into principal to make up for the income shortfall, and it's a downward spiral. We really want to try to prevent that from happening. By the way, if you start into retirement with a fixed income that's about half the income that you need every year, just assuming a trend line 3% inflation rate, these lines cross in year 14, generally speaking. So we really want to be careful about our income. So just looking at, if you're not even preparing for a 3-decade retirement, just be advised, it is preparing for you. The joint life expectancy, of a non-smoking couple that retires at age 62 is 30 years. It's age 92. That's, in other words, this is the point at which the second person passes away, tends to be age 92. For those of you that are good with statistics, you'll see that that's at the very top of the bell curve, which means that there's a lot of people on either side of that. So those little dots to the right, that's pretty much everybody on this webinar. And why would you ask, why would that be? It's because just about everyone in our practice that we've seen either has better educations, better health care, has had better jobs, better income, than most other Americans. And so you can't count on being average, because you have the resources to extend your life even longer and take care of yourself, provide for long-term care and so forth. So we really need to be planning, for a further age. In most of our financial plans, we take that out to at least age 95. And with some of our clients who have longevity in their family, we're even running financial plans now out to age 100. So we really want to plan for that 2-person 3-decade retirement that we're looking at. So another way is just to envision for a moment you're in your retirement home, and you get up in the morning with your spouse, you go sit on your front porch, you watch the sunrise, one of you walks out and grabs the newspaper. If you're a newspaper reader, breaks out your tablet to read what's there, and you're about 85 years old, and you walk down to the street for that because you still can. That's really kind of what you're looking at in this scenario. So we really need that income to keep up. So let's get into some of the math on this for a minute. Just let's assume for a moment that you need $8,000 per month of income on top of your Social Security. So to help offset inflation, your income would need to rise about 2.5 times over a 30-year period, just assuming a 3% trend line inflation rate. So in other words, if you needed $8,000 on top of Social Security in year number one, you would need about $9,200 in year five, $10,600 a month in year 10. You can kind of see how the graph works there. Out to year 30, you're more than double what you needed, in the first year of your retirement there. So almost 3 times what you needed in your first year. So a growing income is essential. So our question is, where historically do we find that kind of rise in income? And it's likely not going to come as a surprise. It's going to be by owning companies as opposed to lending to companies. So lending would be bonds, fixed income securities. By definition, fixed income does not produce a rising income. It produces a fixed income for the life of the bond. So it's going to have issues with keeping up with inflation the older that bond becomes. Mainstream equities, though, which are those you would find in, say, the S&P 500, the largest 500 companies in America, historically do have rising income streams, most notably in the form of their cash dividends. So to sum that up, rising income and sharply rising income has most reliably been produced through the ownership of successful companies. So how do we go about building that? Just want to note for a moment, in my mind, dividends are the ultimate inflation killer. So let's just look at what that's looked like since 1960, which is really what's happening over the lives of people that are headed into retirement right about now. Now, this is, back in the 60s was when they were a lot younger. And so now we're there and moving on into retirement. So since 1960, the consumer price index has gone up 10 times higher than where it was in 1960. Meanwhile, the cash dividend of just the S&P 500 index is 34 times higher than where it was in 1960, 3.4 times higher than the consumer price index. So it has historically compounded at least twice the rate of inflation over that entire time period. By the way, since 1960, what has the value of the index itself done? It is up 66 times higher than where it was in 1960. So these rising equity values over long periods of time can give you even more room to increase withdrawals because you can dip into your profit if you needed to. And it can also help you build wealth that you can leave to people you love or give to charities that you care about, pay for grandchildren's college educations. The list can go on and on there. Now, we have to say here, this is where we tell you that past performance is no guarantee of future results. I think everyone on the call probably knows that. But when we sit down, we can walk through the actual numbers of your lifetime, from your date of birth. If you'd like, we can find that information. So calculating your number, let's just kind of take a look at that for a minute. We get this question often of, Mike, what kind of capital do I need to be able to retire? And this is a very simplistic approach to this that I just wanted to show conceptually what we're looking at to generate the income. So just assume that in year one of retirement, that you're looking at needing to replace income of $250,000. Again, I don't know the incomes of everyone that's on the webinar this morning. Let's just use this as an example for an affluent person who had income pre-retirement of $250,000 a year. Let's take $50,000 off of that for Social Security. That's probably about the right number for somebody at that income level. So in that case, we're needing to generate $200,000 per year from your portfolio and other investments. Let's just assume a 4.5% distribution rate, which might be a tad high, but it helps with the math to kind of show that the easy way to go about this. You take that $200,000 per year and divide it by 0.045. And you get a number of $4.4 million. So what we're asking here is how much capital would it take at a 4.5% withdrawal rate going in year one to produce the income you need? And the answer is, if your draw rate is 4.5%, you need $4.4 million. Now, on the other hand, if your draw rate is lower, like say 3.5%, you would divide that number by 0.035. And you're going to get an even bigger figure, because we've got a smaller divisor there. So in other words, your distribution rate is going to impact the amount of capital that you need to have put away. But we also want that capital to be growing along with the dividend stream there. So this is really an oversimplified way to go about it. You can figure out what your income needs are going to be, subtract out your Social Security, divide by an assumed distribution rate, and that'll give you a ballpark figure. Now, the key thing to note here is that this will also assume you're only taking the income off the portfolio, which means you would be leaving that $4.4 million at the end of your lifetime. For a lot of clients, that's not exactly realistic. Usually the income generated from a portfolio isn't going to be 4.5% unless you're taking a lot of risk or have really good stock selection in your portfolio. So usually it's a combination of dividends and some capital gain taking along the way. So you might be depleting some of your capital over time. I think that's why it's important to project that out and see what it looks like. But in this little oversimplified scenario, you begin with your 4.4 and you end with your 4.4. Hope that makes sense. All right, so talking about increasing your cash withdrawals, everything becomes more expensive over time. So with this kind of a rising dividend type portfolio, you'd be able to increase your cash withdrawals at 3% per year. Sometimes we see in reality, most clients are able to live on the same amount of income for 2 or 3 or 4 years. And then they realize things have gotten kind of tight. We need to bump up a little bit. So if there's any surplus income in the portfolio at this point, you can reinvest what you don't need. You can give some away. You can pay for grandchildren's college like we talked about. The list can go on and on and on. But you get the idea here is that you really want your income to be able to increase. And we've really shown that good dividend paying companies are the primary way to go about that in your portfolio. So what should we do now? Obviously, the financial plan, needs to be a personal type plan. You really want to start with refining your personal income need. That's something we can help with if you have a challenge figuring out what your expenses are. Quite often, too, if you're still working, it's really easy to figure out your net income from your paycheck. If you're making ends meet that way and you're not running up your debt, then that's a good number to start with. And then we can adjust that up or down. But you really want to begin with what your retirement income need is going to be, and then have your Social Security and pension numbers available, as that number gets subtracted, from your income need to help you back into the capital that you would need to generate the income that you're talking about. So in terms of planning with purpose, the old adage that we kind of go with is if you aim at nothing, you're sure to hit it. So we like to help people have a financial plan put in place. So we'd be walking people through defining their 3-year vision for their financial plan, walking through our 90-day milepost. We'd be stress testing the financial plan over 1,000 different market scenarios to see what its success rate is going to be. Then we want to look at your investment risk and align your portfolio with your goals, help you organize your finances and collaborate with you in an online tool that we have called eMoney. And then where appropriate, we can assist with business and exit planning. So strategies that we have implemented along the way to help generate, some of this income realistically has been a focus on value type companies, which are companies that are either underpriced or, like Goldilocks would say, not too hot, not too cold. We don't want to overpay for some companies. And then we like to tilt a little bit more toward dividend payers that have a history of rising dividends over time, and make sure that's a significant part of our clients' portfolios to generate income. The yield on the S&P 500 right now is hovering around like 1.8, 1.9%. Most of our dividend-focused portfolios are yielding 2.5% or above with the tilts that we're talking about. So that's one idea, is to be looking for underpriced type companies, screen for companies with high dividends, screen for companies with a history of raising their dividends. Then another tool that we've been able to put in practice with certain clients is a managed stock account where we co-manage it with a company called Federated, and they will focus on strategic companies. It's called a strategic value dividend managed account there, and they will help screen that out with about 50 to 55 companies yielding a total of around 4.5 to 5%. That's why I think it's good to partner with a manager that specifically does what you want to have done as opposed to trying to screen these companies on your own and hope that they stay in business over time. Annuities can make sense for certain people. When we do the stress test in a financial plan, if the success rate is very low, which means that there's a high probability that they run out of money, that's where an annuity could make sense to kind of generate that private pension. There are definitely some pretty bad annuities out there. There are some pretty good ones too, so they have to be carefully screened. But realistically, those are some of the primary tools that you can put in place in your investments to generate lifetime retirement income. So with that, we're not going to go the full 40 minutes today. I wanted to thank y'all for attending, but I definitely want to see if there's any questions that we can answer for anyone this morning, or anything that we haven't covered that you'd like to make sure we cover. So I'm going to open up the floor for Q&A.
Mike, I just had a question about the where we were trying to find the $200,000 and you doing a 4.5% draw.
Right.
I don't understand. I guess I'm not really following it. Why, if you do a lower draw rate, would you need more money? I would think you would need less money. I'm not following that topic there. Because you were saying if you take it to a 3.5% draw rate, I would think, why would you need $5 million? If you're gonna draw off less money, sense. Maybe I'm thinking about it wrong.
No, that's a great question. So in that scenario, the number that stays the same is the $200,000 of income. So put it another way, if we're needing to generate $200,000 a year, and let's say we have a $5 million portfolio, so that $200,000 divided by 5 million, that's going to be a 4% draw rate off the $5 million. On the other hand, if I've got a $3 million portfolio, but I'm also drawing $200,000 off of it, that's a 6.7% draw rate on that portfolio. So it's kind of like that seesaw. It's like an inverse type relationship. When our divisor, which is that interest rate of either 4.5% or 3.5%, the lower the rate is, if our income is the same, it's just a bigger percentage of the number. So that's why if we have a lower distribution rate, the capital's got to be higher. There. Now, a lot of studies that we have seen, you bring up a good point, kind of tell us that what I would call a safe distribution rate is really more in line with about 3 to 3.5% when you kind of stress test that out a little bit. So we used a 4.5% rate in this scenario to really account for expenses as well, because as y'all know, mutual funds and ETFs and even advisors, there's expenses that come into play there that have to be factored in. So, if you're hiring an advisor, there's that. If you're using mutual funds and ETFs, they've got their own expense ratios. So we really wanted to account for that in the overall mix of the distributions. So that's why I plugged in 4.5%. I basically took 3.5 and added 1% to it, to cover expected costs. Well, I hope this very high level discussion was helpful. In these economic times right now, it can be challenging to go against our impulses to become much more conservative in our portfolios. One other point I'd really like to bring up, is what do you do with all of this in a year like 2022? If you're one of those folks who had to retire last year, the markets are going down. The markets don't know that you're retiring. The markets don't care that you're retiring. The markets do what they're going to do. What do you do in that scenario? You do want to make sure that you have a buffer in your portfolio that can insure you against that. And now with interest rates being back at, what I would say are reasonable, not quite reasonable, a little bit higher than they usually are, but where they have been in the past, a money market fund for part of your portfolio can make sense if you can find one paying about 4.5%. That's not a bad place to park, 6 months or a year worth of your income. Obviously, some bonds or some bond funds can come into play to kind of be the ballast in there, for 2 to 5 year type money. So that's really what we're looking at is buckets in your portfolio, like a short-term bucket, kind of a mid-term bucket. Those will have much less risk than an equity portfolio and likely would not be invested in equities. And then you have your long-term bucket, which would be your equity portfolio for generating lifetime income off dividends, rising dividends, capital appreciation, and so forth. So If you're that person who retires in 2022, or going back in the Wayback Machine, 2008, when the markets went down 45% in 1 year, it's real simple. You can take your dividends, but don't take your stocks. You would want these safety nets in the portfolio so that you can draw your income from the money market, from the bond funds, knowing that most recessions and down markets last anywhere from 9 to 18 months. And so you want to give the equity side of your portfolio time to work through that cycle. And when you see investments are moving back up again, then you can switch your income over to maybe some equity withdrawals if you need to, and leave the short-term and mid-term buckets alone and kind of rebuild those back. So that's generally how we would advise clients to manage that, is just to look at their 3 buckets, make sure they have 3 buckets in the portfolio, and manage where their distributions come from, and review that every 6 to 12 months to make sure you're not selling off investments that are going down in value. We definitely don't want to be doing that. With that, I really thank everybody for your participation this morning. If you think of some other questions along the way, feel free to shoot us an email. We're happy to help where we can. And we look forward to catching up, and wish everyone a good, safe, happy, healthy, and fun summer. Thank you very much.